The three different types of credit. The basic idea behind credit is simple. Borrow now, pay back later. But there are actually three main types of credit, and all of them can impact your credit score. The first type of credit is installment credit. You borrow a specific amount, then you make regular payments of a fixed amount over a specified time. Home mortgages, car loans, and student loans are installment credit. Let's use a car loan as an example. You pay a monthly fixed amount, and the time period, usually a few years, is specified up front. The second type of credit is revolving credit. The lender extends a credit line, which you can use repeatedly for as long as the account is open, and you keep making required payments. Revolving credit includes credit cards, department store cards, and home equity lines of credit. For example, a credit card with a $500 credit limit allows you to spend up to $500. But when you repay all or part of that balance, the amount you paid is available to use again. The third type of credit is open credit. The amount due may vary, but it's usually due in full each billing cycle, and there's typically no preset limit. Utility services, which charge you based on your usage that cycle, are a common type of open credit. Charge cards are another type of open credit. Unlike credit cards, charge cards are expected to be paid in full each billing cycle. Otherwise, there's a risk of hefty fees or even account closure. Now, let's see how the three different credit types affect your credit score. Under the FICO model, payment history is 35% of your credit score. All three credit types affect this, so it's important to make consistent, on-time payments with all your accounts. Next up, amounts owed for 30% of your score. This only considers revolving credit and focuses on how much you owe as a percentage of your total available credit, also known as your credit utilization ratio. Many experts suggest maintaining a credit utilization ratio of 30% or less. Length of credit history makes up 15% of your score, and all three credit types play a role. Installment loans close once they're paid in full, but keeping credit or charge accounts open, even if you don't use them often, can help this part of your credit score. Credit mix weighs in at 10% of your credit score. This refers to the mix of different credit types you use. So, of course, all three credit types have an impact. Finally, there's new credit. This is 10% of your score and considers all three kinds of credit. Lenders like to see that you aren't taking on too much new credit all at once. So, if you're shopping for a car loan, looking at credit cards, and considering a charge card, you may want to space out your applications a bit. As your credit needs change, there's a good chance you may be using more than one type over time. Knowing how they all work can help you get the most out of your credit.